Hello, Hamish here from Mortgages Online. I've got Gary with me, a seasoned property investor, has been in the Herald a few times. We're going to talk property market, right, Gary?
Yeah, let's get into it.
Yeah, what do you think? What's happening out there, mate?
Well, obviously the property market is really slowing down. If you look at only the medium house prices from the RNI, NZ, etc., you're not going to get the full picture because those prices are generally houses that probably have settled recently, but they've been purchased, a couple months ago, right? Really, what you need to really check is the, for example, if you're in Auckland, Bath and Thompson, the auction success rates. So normally a decent market, you're looking around 60% auction success rate. Mm-hmm. Most recently, it dropped as low as 25%.
Wow. Okay, so that's
massive.
A big shift.
That's massive drop, right? So if that continues, you're gonna start to see a buildup of inventory. That's right, and things like that. And obviously, very soon, it's probably already starting now, is that vendor expectation is going to have to drop. Yeah. In order to meet the sale. Now, I'm not saying every house in the market is going to be staying on the market. The ones that, for example, there's always the demand for homeowners, right, looking to upgrade their home or buy their first home, etc. But yeah, so what I've seen in the market is really because of the CCCFA changes, the banks have really tightened up in terms of lending criteria, etc. And that's obviously flow onto the market because most of the people buying in the market today, they need to get a mortgage, right? So really CCCFA and the banks is really causing this in my opinion. And consequently now you're seeing the effects of that. And then obviously you don't have that FOMO anymore. If you look at, if you listen to like Tony Alexander and all these economists, etc., they're all saying FOMO is out, and that's what you see in the market. Auction success rate 25%. That tells you the whole picture of what the market is, especially in Auckland. And that's pretty much it. Sums it up.
Well, I think it's interesting that you point out the CCCFA, right? So that is one factor. There's probably a few. Let's face it. There's been a whole host of stuff for investors and stuff that's kind of scared them off quite a bit. Well, increase the costs, right?
Yes.
Rents can only go so much, right? Because people were now paying more in fuel, more in grocery bills. They can't all just compete for higher rents. It's just not going to happen. But on a positive light, let's look on the horizon at some of the things that might lead to a little bit more strength later on in the market, but also maybe some opportunities, right?
Well, opportunity is probably another video because it's before we go to the sunrise, there's more, right? There's more to it than just CCCFA. On LinkedIn, I post like 6 reasons why I think property market is heading towards a winter. And then obviously subsequently, the word credit crunch has been used. So it's not just CCCFA as well. The other thing is we're not getting the migrants as we're getting the last few years. With border opening up, more and more, probably some Kiwis will be leaving to Australia, etc., to escape what's happening in New Zealand, all right, political sense, and seek for better pay, especially with inflation, double-digit inflation we're seeing really. And the biggest one is interest rates, because the interest rates now is like 3.8, 3.79, 3.85% for 1 year.
It has gone to kind of pre-COVID days.
Right? But the thing is, like, the house prices have gone up 40% since COVID. And we might have dropped back a little bit, right? So the house prices have gone up tremendously, 30, 40%. But the interest rate now is returning to pre-COVID. So affordability is 40% worse.
Yeah.
And has real wages really gone up that much? Probably not.
No, you're right.
So that's a big issue. And now the banks have squeezed in the what they call the money bag, the pocket, the funding. So you're having double whammy kind of effect on the property market.
Yeah. Now, in terms of the kind of shoots to watch out for, I think, going forward, because I think initially you will definitely see it reflected on the median prices. Things are going to change. But one thing is, Gary, there's a lot of immigrants that are about to get their PR, permanent residence, a whole bunch, and some of them are ready with cash to buy. I think the other way to look at it is a lot of the issues which have dragged us down on the horizon might only get better. So supply chain will probably start to move a bit easier at some point, because a lot of countries outside of New Zealand are actually opening up. They are actually getting things moving again. And so you might start to see shipping costs and things start to go the other way. And I think at some point, and I know it's a bit early to talk about, but at some point we are going to see the return of tourism, international students. These things are going to happen. It can't get worse, is my point. Right?
The big issue is unknown, is how soon those things will come back, right? And then those things you're looking at 12 months plus.
Maybe because if the pressure is on, it could you would hope that it could happen earlier, because I know tourism operators out there, if you're going to let all the Kiwis out, there's nothing for them. They're just hanging on, and you're not replacing the Kiwis going out with someone coming in. You know, some of those people will not be able to survive. You know?
Well, I mean, that's the problem is the next 12 months, that especially for the economy, is that you got a shortage of people, skilled people. You got a really rising interest rate. You got a dampening, slowing property market. That's not going to help the economy. And you know, if the time horizon is 2-3 years, I'm positive. But the problem is now is the immediate 12 to 18 months. Especially with the banks, you know, tighten their credit, interest rate going up. Those are the two biggest issues. And then if the property market stays like this, stays really low, where the auction rate is so low and all that, people are less likely to pull the trigger to buy the property. They could also affect people pulling the trigger to do a major home renovation or buy a new car, etc. With petrol prices $3 now, right? Depending which car you drive, what kind of car you drive. So this is a massive headwind that if the government and the Reserve Bank and the banks don't loosen up credit sooner, it's that after effect, that flow-on effect is going to affect the economy, and ultimately the economy provide jobs. Well, businesses, healthy businesses provide jobs, and that ultimately what keeps the property market up is the jobs. At the moment, we got a really low unemployment rate, right? If this credit crunch continues, we're going to have a big impact.
Well, hey, look, thank you for watching. Hopefully that's been kind of insightful to hear our opinions at the least. But thanks for coming in, Gary.
Right, cheers.